Okay, we've got quite a few joined us now, so we will make a start on this morning's session. Clue is in the title. Today we are going to be looking at financial reporting and upcoming changes to FRS 102 and what it means for you and your businesses. But first, a few housekeeping matters. Now, last week I did a charity webinar and there was a lot of technical issues before we started. So given that there's been none today, I'm anticipating there may be some during. I'm hoping not. But if there are any issues or you can't hear, etc., then you can also log on via telephone so that you can get the audio and the details are there on the screen. Please feel free to ask questions via the chat function. I will pick up these at the end of the webinar. Please also feel free to contact me directly. My email address is on the screen, or of course any of your connections at Mitchell Charlesworth. The session is being recorded and will be circulated with the slides after the webinar has finished. So please don't feel like you have to take extensive notes because you will get those. So just a bit of an introduction. My name's Louise. I'm one of the partners here at Mitchell Charlesworth and I head up our audit service. Have a mixed portfolio of corporate and not-for-profit clients and work quite extensively on the financial reporting side of things. I'm obviously supported by a fantastic team here at MC. Many of you have contacts within the firm, and we offer a full suite of services from audit and compliance, accounts, right through to advisory services. We are starting to do some special projects based on what you are going to see in today's session. So this is the second of our webinar series. Last week we had our charities webinar, as I've already alluded to. Today, focusing on corporate entities and FRS 102 changes. And on the 15th of April, we have a session for housing associations. And we will also be putting on a more specialist session for our academy clients. So, of course, we know FRS 102 is the main UK accounting standard, and it does provide that core framework on how we measure, classify and present financial statements within the UK. We have a number of changes that we're going to go through today. So why have we got that? The FRC have recently undertaken quite a comprehensive review of FRS 102 as part of its usual cycle of reviews, and they are looking at how they can better align UK reporting to that of the international standards. And as a result, you'll see today a number of aspects that are closely aligning to that more international focused way of reporting. So what are we seeing? We're seeing improved revenue recognition reporting, and we will go into quite a lot of detail around what that actually means in practice, particularly with the introduction of a 5-step model, which was in place for international reporting and is now being introduced. The second most significant change is in relation to lease accounting. And leases being recognised on the balance sheet as right of use assets. So this is probably going to be the most material change we will see on balance sheets for a number of years. And there are quite a lot of details to go through on that front as well. All of the changes are aimed to bring better transparency and enhance disclosures so that there's more consistency across sectors and stakeholders can better understand and benchmark against financial statements. And of course, there will be enhanced conceptual framework and measurement, which will also mean that some changes to fair value and judgmental and estimates within the financial statements have a bit more guidance so that when you are making those judgments and estimates, you have the background guidance that most people will be following. So the overall purpose of the amendments is to obviously, as I've touched upon, ensure that consistency between the UK GAAP and international reporting practices, increase the usefulness and reliability of financial statements by offering that consistency, particularly when looking at lenders, investors, other stakeholders who are looking for that transparency of financial statements, and ensure that standards remain current and responsive to evolving business practices. But we haven't just got that change. Alongside these changes to FRS 102, we've also got a number of changes to accounting thresholds, which take effect from the 1st of April, further reducing administrative burdens for smaller organisations. So what are these changes? They have brought in an increased threshold for the definition of micro, small and medium-sized companies. This has actually brought about 113,000 companies moving from small to micro. 14,000 move out of that medium bracket down into small, so removing the need for an audit. And then 6,000 move from large to medium, so some reduced disclosure in respect to particularly around narrative reporting. So entities moving from that small regime, as I've touched upon, may be exempt from audit. However, what we'll see today is that a number of the changes that bring an adaptation to the way that certain items are measured in the financial statements may actually make those changes irrelevant. So just looking at what those changes are, you'll see from this slide, micro turnover is increasing to 1 million, the small threshold 15 million, and the medium threshold increasing from 36 million to 54 million. From a balance sheet point of view, we're seeing increases of a similar level to increase micro from 316,000 to 500,000, small up to 7.5 million, and then medium to 27 million. Now, that is no change to the monthly average of employees, and please remember that it's the 2 out of the 3, once breached, take the entity into that next bracket. So that's a bit of a background as to where we are and how we've got here. So we will get stuck into the nitty-gritty, very conscious there's a lot to get through. But we will start by looking at our revenue recognition, and particularly that of the 5-step model that is being introduced. So you'll see here just an overview of where we are and where we are going. So from a revenue basis, historically been recorded on the risk and rewards model, that is now being moved to this 5-step control-based model, and that's going to be the focus of today. When we're looking at bundled goods and services, historically there's been quite limited guidance as to how to debundle and allocate those transaction prices, whereas now there's a real specific item of how you identify those performance obligations and how you use them in practice. We will go through some examples of that today. And then variable consideration. Historically, we've had very basic treatment of this, very limited guidance, whereas now there's very explicit rules as to what needs to be implemented. So today, as I've touched upon, we're going to walk through that 5-step model, which forms the foundations for recognising income under the new FRS 102. So the aim of this is to help you understand not just the rules, but how to apply them. And we will go through some very specific scenarios. And this will include identifying the distinct performance obligations, considering and handling variable consideration, determining the standalone selling prices, which is really crucial, choosing between input and output methods, and understanding when a performance obligation is satisfied. So you can see here those 5 steps quite clearly labelled, and this is giving greater focus on that performance obligation. We will touch upon what the transition looks like, but for income, there is choice around retrospective or modified retrospective options. So let's start with step one. So step one is identifying the contract. So the contract is an agreement that creates the enforceable rights and obligations. And in practice, this may be a written contract, an email exchange, purchase order, a grant agreement, or it could be a verbal agreement. To be valid, it must show approval from all parties, clearly defined rights, clearly defined payment terms, and commercial substance. Now, the auditor in me says that actually the best document would be a formal agreement, but that's not always practical if you are selling goods, for example. So what we want to identify is what are those enforceable rights and obligations? What is probable that the entity will collect in consideration it is entitled to by satisfying that contract? Once we've identified the contract, the next step is to identify what within that contract is the performance obligation. So the performance obligation is the promise to transfer a distinct good or service. Now, the customer can either benefit from that good or service on its own, and it is separable within a contract, or it might form part of a bigger service. What is really, really crucial is identifying if it is distinct. So you can be distinct if both of the items on the screen are met. So the customer can benefit from it either on its own or together with other services, and it's separate from other promises within the contract. So picking at the contract to really understand and identify those performance criteria is really, really important. So factors that might indicate two or more goods or services are inputs to a combined service. May be that the seller provides a significant service of integrating the goods with other goods or other services, representing a combined output. So an example here might be a construction contract. One or more goods or services significantly modifies or customizes the other goods or services in that contract. So an example here might be software customization, or the goods or services are highly independent or highly interrelated with other goods and services. Now, what we've previously seen in section 23 of the FRS 1.2 is that it does jump around a little on specifics and what needs to be considered as part of this. But what is really, really important that as you are reviewing contracts, reviewing your income recognition, that you clearly identify what those performance obligations are. Do need to be mindful if there are specifics within the contract, particularly around warranties, any non-refundable upfront fees, for example, gym memberships, customer options, if you get the option to, for example, get a discount on a future purchase, and also that principal versus agent consideration. So a couple of examples here. I wish I was as tech savvy to do a poll. Unfortunately, I'm not, but we've got two scenarios here. Just going to give you a minute to have a read of those and a bit of a think. So the first one is a construction company agrees to contract an extension to an office block. It completes the groundwork, building, roofing, plumbing, wiring, and decorating. So do we think there are a number of performance obligations in this example or just the one? The second scenario is a manufacturing company sells goods to a customer with a free warranty and offers a 25% discount on their next order if it is made within 90 days. So if we look at the first scenario, so the key here is what has been contract to deliver. and that is a complete finished extension. So even though there are various elements to reaching that, with the groundwork and the wiring, etc., there is actually only one performance obligation, and that is to deliver the complete finished product. In the second scenario, it's a bit different. Now, you aren't going to guarantee that they're going to use the free warranty or need it, and you aren't going to guarantee that they are going to take you up on the offer of the 25% discount. However, the machine can be sold on its own, so that is one performance obligation. The warranty, even if it is free, they've promised to deliver, therefore this is separate as well. And then the discount, now this is the more judgmental aspect of this scenario, but is it considered to be a material right to that customer? And I would say 25%, it could potentially be quite material. Would they have been able to buy the machine and not get that discount? No. So you could think from a bundling point of view, you wouldn't have got one without the other. But for the ability and the purpose to actually record it and go through those steps, it will probably be a judgmental based on how probable is it that the customer will actually take that discount and use it. And that might be the part that is difficult to measure a price, but from a performance obligation would form a separate obligation. So in summary, construction company with an extension is one performance obligation. In the second scenario, we actually have 3 performance obligations. So step 3, once we've understood the contract and we've identified what those performance obligations are, is to determine the transaction price. So the transaction price is the amount the entity expects to receive in exchange for the transfer of the goods or services to the customer. Now, this may be a fixed consideration, variable consideration. It might be a sale with a rate of return. It might include any discounts or rebates. It may even include performance bonuses or penalties arising. It may be non-cash consideration. So there's a lot of elements that you need to consider when determining what that transaction price is. And it's probably no surprise that the most complex element of this is that variable consideration. So we will focus on that and what that demonstrates. So variable consideration includes any amounts that depend on future performance, uncertain events, potentially satisfaction levels, usage or consumption, and quite often is found in discounts, rebates, refunds, or any performance bonuses. So for example, if they complete a project early, or if you are having a rebate for a certain level of turnover with that specific client. So they must be measured based on expected values or the most likely outcome. And these 2 methods are what we will focus on today. So it should only be included in the transaction price to the extent that it is highly probable that it will be entitled to the cumulative amount of revenue arising from that variable consideration. And you'll see here I've put the actual reference to FRS 102 because it is quite explicit around when you would be recognising that income if there is a variable consideration. So a couple of examples here. Again, we've got a construction company agreeing to contract an extension to an office block for a fee of 5 million. Contract terms state that the work is completed by the 30th of September. A 10% bonus becomes payable. The construction company expect to meet this date. So here what would you do? Would you look at expected value or the most likely outcome? I think in this case, you'd be looking at the most likely outcome and the probability of that happening. Now, we can see here that the construction company expect to meet this date. And it's quite clear that either going to receive it or not. It's either they meet it or they don't. The highly probable element is if they are going to meet it, and this is where the judgment and estimation will come in. In the second scenario, we've got a manufacturing company entering into a wholesale contract with a customer, offering a yearly rebate on a tiered basis from 1% to 5%. So in this case, there is probability, of course, but there's also a tiered approach. So therefore, the expected value method would be better here to identify what levels of income they've received based on the outgoing, that weighted probability to identify what can be brought into the accounts based on the agreement. Step 4, we're now looking at allocating the transaction price. So we've done all the hard work. We've identified the performance obligations. We've identified the transaction price. So now we need to allocate that total price based on the standalone selling prices. So this is identifying what proportion, if that element was sold on its own, would be attributable to that income. So this might be determined by using actual list prices, market assessment, a cost plus based approach. In some cases, if the standalone selling price isn't directly observable, it will need to be estimated. And this is where the complexity comes in. So if we take that example about the 25% discount if they reorder, how do you actually measure that? So got a scenario just to have a look at here. So again, we've got a manufacturing company, sells a machine, and it sells with installation and a 2-year servicing package. So this is £75,000. The machine can be bought on a standalone basis for £60,000 or bundled with installation for £70,000. The standalone price for installation is £15,000 and the standalone service charges are £3,500 per year. So how would the transaction price of the £75,000 be allocated to those performance obligations? So if we look here, you can see we've broken down those products and services into the machine, installation and service. We've identified what the standalone price is and the total, and we've identified the percentage of the total by the different elements. And then we've applied that percentage to the proportion. So that seems a sensible way of doing it. However, as we can see, we do have discounts allocated to specific parts of the contract. So your installation has been reduced and the service has been reduced. So what we would need to see is what element of those discounts are to be apportioned to each of those specific aspects. So you can see here, we've got 80% of the discount allocated to the machine, 20% discount allocated to the installation, and the service we know absolutely categorically is £2,000. So then when we look at those allocations of the proceeds, it does slightly change the apportionment between those 3 aspects. In this case, it's not material, but if you sold a number of these machines, then suddenly you are looking at a material difference between a simple apportionment and allocating that discount across the debundled service. So our final step, once we have established all of the different elements, is to recognise the income. And this can either be done at a point in time or over time. So the focus here is when the control passes from the customer. And you will find that at a point in time is most likely when you are selling goods, and over time is services or contracts, because you have certain performance criteria in which to measure. So at a point in time, you've got the entity has a right to receive payment, the customer has taken control and has that legal title, they have physical possession, and the significant risks and rewards have been transferred. On the over time perspective, it's very much looking at when the customer receives and consumes the benefit, when the entity's performance creates or enhances an asset that the customer controls, the entity, sorry, just frozen slightly. So the entity creates an asset or creates an alteration that can't be used by anyone else. And I think professional services here is a really good example. If we're providing a piece of advice for a specific client, that isn't transferable to another client. And quite often, from the over time perspective, we will be looking at the output or input method, which we will look at in more detail. So when recognizing income over time, we must select the method that best reflects progress. And we have two options here, either the input method or the output method. So the input method measures efforts or inputs. So for example, hours worked, costs incurred, resources consumed. And this should be used when those inputs directly relate to the progress against that project. On the other side, the output method measures what's been delivered. So examples of this might be on a contract where you've got a valuation, or there's milestones achieved, or there's units delivered, or a report's been completed. So quite different ways of identifying that stage of completion on those contracts, but it should be really evident when you're looking at your contracts which one it best fits to measure that income. So you can see there is quite a lot to consider. There's quite a lot of nuances involved in actually understanding those performance obligations, identifying and allocating those transaction prices. And what we expect to see here is a change in when income is recognized in time. So it may be that income is brought forward or deferred based on those 5 steps being followed and evaluated. So this may impact obviously your financial statements. In turn, that might impact performance-related pay schemes, any KPIs or internal or external reporting, budget setting for the year ahead, and it also may have corporation tax impact where you are obviously bringing in income earlier or recognizing it later. So the next significant change we're going to see is in respect of lease accounting and right of use assets. So from a lease accounting point of view, a lease is a contract that conveys the right to use an asset for a period of time in exchange for consideration. And it's also a right to control the use of that asset. So what we had previously seen is that on an operating lease, you would reflect that in the financial statements on a straight line basis as the lease payments were made. We're now replacing those operating leases with a right of use asset and a corresponding lease liability. And you'll note here that it does allude to the present value of those payments, and we will see what that means in practice. So, some things to have a think about. From a present value of future cash flows, we need to be thinking about, well, what's an appropriate discount rate? What is the lease term to calculate the future cash flows over? And that might not be extremely clear-cut in some circumstances. Are there any additional initial direct costs being incurred? And is there any accounting needed for non-lease components of that agreement? Are there any lease payments made or lease incentives to be received before commencement of the lease? And is there an estimate of obligations for any dismantlement provisions, any restoration provisions that should also be brought in to the lease calculation? So other considerations might include whether there's a break clause or an option to extend. What's the likelihood of that happening? Can you look at past history to determine how you've previously treated this? Is there an intention to break the lease? Has there been any significant leasehold improvements that may result in a restoration provision being needed? So lots to think about in just simply reviewing the contracts, and that's before we get into the detailed calculations. So from a lease accounting point of view, our initial measurement will be to identify that right of use asset and corresponding liability, of course using the present value of the future cash flows. So the profit and loss impact will be that you are now recognizing depreciation and interest where the previous treatment would have been a rental expense going through the profit and loss. Looking at that discounted interest rate, now there are a couple of options outlined within FRS 102 as to how that should be calculated. If there is an interest rate implicit in the lease, then that's your first point of call. If there isn't, then there is two options to either use the incremental borrowing rate or the obtainable borrowing rate. I've outlined here what that means, but in essence, it's what would the cost be to borrow a similar amount for a similar asset with a similar level of security over the same period. In most cases, if you do have borrowings, that would be an initial benchmark, but it is something that's going to need quite detailed consideration to get to the right discount rate. And of course, it's not going to be a one shoe fits all. You may have differing rates for different classifications of leases. The initial measurement, as we've already mentioned, does also need to include any variable elements. And it also needs a lot of consideration if there is no formal lease or if it is on a rolling lease basis, because here you would need to probably get some guidance as to what the contract implies, and is there actually a commitment even if there isn't a written formal agreement in place. There are some exemptions, which you'll be pleased to know. FRS 102 is fantastic at telling us what doesn't classify as a short-term, a low-value lease, but it doesn't explicitly say what would be included as a low-value lease. So the two exemptions are either a short-term lease, so 12 months or less, or low value. I've listed here what it says is not low value, and I think the second bullet point in respect of cars, vans, buses, coaches, trams and trucks is probably the most relevant, because a lot of entities will have cars on operating leases, and unfortunately it does explicitly say that it does not fall within that low value exemption. What may be considered low value could be mobile phones, photocopier, franking machine leases, and potentially laptops. So we've looked at the initial measurement, we've looked at any exemptions. So what happens then? So the subsequent measurement would be that the lease liability reduces by those payments being made to the lease company, and increases by the unwinding of the interest. Obviously, this means that the profit and loss is going to be front loaded with a higher amount of interest in the earlier years, as it then reduces the liability. The right of use asset can be measured on the cost model, revaluation model, or fair value model, albeit it would be quite straightforward to apply the cost model and depreciate it over the life of the lease. On the face of the balance sheet, it can be presented as a separate line or included in your fixed assets and then broken down in the notes. However, there are a lot more extensive disclosures that are needed in the financial statements, specifically around detailing what those right of use assets are, expenses relating to the interest, any short-term leases or low value assets, from a cash point of view, what the cash outflow is, and then a reconciliation of those right of use assets. Now, we touched on the income side and the tax impact being, fairly self-explanatory from the point of the income being recognised in a point of time, earlier or later. With the lease accounting, we've sort of touched upon here around what the tax impact is going to be, because of course the operating lease expense would be allowable deduction, straight line, really easy in the tax calculation. However, as with hire purchase agreements, the right of use asset depreciation and finance costs will be allowable in the tax comp, but of course we're going to have this timing difference with when those finance costs are recognised. So although the accounting treatment and the timing of the tax deductions will change, the commercial substance of the lease will be the same, and over time the total allowable deduction will be the same. It will just be obviously slightly front loaded, as we've seen. So some of the impacts that we're going to see as a result of these changes to leases are primarily from a financial statement point of view, going to be on the primary statement. So we're going to see statement of cash flows being impacted. So where it was previously operating leases were included in the operating activities, they're now going to be shown under financing activities. On the balance sheet, you're going to have these new right of use assets with a corresponding liability. Of course, the current asset calculation is therefore going to change because the liability will be in there, but the right of use assets going to be within non-current assets. This is going to impact KPIs and reporting, as we've touched upon, but it may also impact bank covenants. So it's really important that you understand nice and early what the impact of these leases are and how it is going to alter your balance sheet, so that you can have early discussions with the bank if you do believe there could be potential breaches in those banking covenants. So as I've mentioned, the transition adjustment, so just re-emphasising that this comes in from the 1st of January 2026, so periods starting on or after. There is the opportunity to early adopt, but if you do early adopt, you have to early adopt all aspects of the FRS 102 changes. So there is going to be an additional and enhanced disclosures in the first year, almost reconciling what was previously recorded to what is now being recorded. With income, you do have that choice, as I've touched upon, between retrospective or modified retrospective. So with modified retrospective, there's no restatement of comparatives. Any adjustments go directly through equity at the date of the initial application. With leases, there is no option. You are expected to apply modified retrospective approach, where you will recognise it as at the date of initial application, and there is no restatement of comparatives required. So we've looked at those two more significant items in quite a bit of detail, but there are some other less onerous changes coming through from the new FRS 102. So supplier finance arrangements, this was actually effective for periods beginning on or after the 1st of January 2025. So this is an item that has already come into play. And this is where you have new disclosures for any contractual agreements you have with supplier, if there is any financing, and potentially reclassification from, for example, trade creditors to borrowings if there is deemed to be a finance arrangement within that purchase. We also have new guidance around fair values, and this is more to align to IFRS, but it does give some more guidance around what is judgment and what are consistent valuation techniques when you are reviewing that fair value price. There is also a change in tax. So the updated standard does require you to disclose any contentious or uncertain tax positions. So if you've recognised a tax treatment that is potentially uncertain, for example, you know, the tax authority or the tax law, and examples of this I can think would be, you know, if there's estimates around research and development tax credits, if there's any, you know, assumptions made when you're looking at specific tax claims or reliefs. If there's any uncertainty, you now have to disclose those assumptions and that uncertainty level that's been applied. Sorry, seem to have frozen. There we go. So some other changes. So there are new disclosures and guidance on share-based payments and business combinations. Not overly onerous, just some small tweaks there. But if you do have share-based payments or if you are looking at acquiring, worth a read through of those. And then more minor amendments, going concern. So there is additional disclosure confirming management has considered all available information about the future. Dividends are now required to be disclosed by different share classes. There is a clarification on accounting policies, and this is really looking at those material accounting policies and the need to disclose those, but not necessarily needing to disclose every accounting policy under the sun. So really understanding which accounting policies are material to the user of the financial statements. There are a few disclosure changes to defined benefit pension schemes. Again, quite subtle changes aligning with IFRS disclosures. And of course, all of these changes do mean that there is going to be higher scrutiny, more documentation needed, and more testing around the particular contracts, particular leases, in order to support the treatment within the financial statements. For those of you who work in organisations that are small entities, there are some expanded disclosures here that are quite big changes. Going concern was previously only mandatory if a material certainty existed. It is now compulsory to disclose the going concern policy. Dividends are also now mandatory. So this is disclosing the amount of dividends paid within the year. You are now also required to include more information around the current and deferred tax reconciliations. Of course, under the old FRS 102.1a, you did get the exemption for disclosing the current and deferred tax reconciliation. And then in relation to related parties, there are quite a lot of changes as to what needs to be disclosed. So previously, the terminology was that you only had to disclose material transactions not conducted under normal market conditions. However, they have removed the judgment as to what constitutes normal market conditions. So normal market conditions has been removed and materiality has been removed. So as a result, this expands that definition of related party to mirror that of a non-small company. So this is going to be quite a big change for small companies. And it will mean that all transactions with related parties must be fully disclosed in the notes to the financial statements. So that was a whistle-stop tour of the significant changes that are coming in. Just to summarise, obviously, we've touched upon revenue recognition and the move to this 5-step control-based model. We've looked at lease accounting and the introduction of right-of-use assets and bringing those onto the balance sheet. We've looked at fair value, obviously historically quite basic guidance, now a little bit more explicit around what judgments and some benchmarks in there to apply. And the supplier finance, previously very limited disclosure, and now we have those enhanced disclosure requirements. So a lot to think about, and when we're looking at it, we obviously need to start thinking about this nice and early to make sure, sorry, I think my computer is frozen because there is nothing coming up on this slide. Apologies for that. I can try and remember what was on there and go through it, and hopefully it will turn up. What we would recommend is a really comprehensive contract review to try and understand, both from a revenue point of view, but also a leases point of view, what is in your agreements, what is in the contracts, and how do you apply the 5-step model if we're looking at income, or how do you interpret that initial recognition for the right of use assets. The earlier you do that and get a real good understanding of what the impacts are, the easier it is going to be to apply it in practice. You're going to need to have a look at those impacts from a transition point of view to help plan for that transition. You're also going to look at system updates and whether there's any accounting software updates that need to be particularly on the lease side, to make sure that they are being recorded correctly. Staff training, making sure everyone is aware of the changes and they're looking out for the right things, particularly if they are heavily involved in income recognition or performance obligation measurement and identifying those transaction prices within the financial statements. Making sure it's communicated to key stakeholders. As I mentioned earlier, engaging with bankers if there's potential that loan covenants could be breached, managing expectations for shareholders where the accounts may look different or have different reporting elements that they're previously used to something else, and making sure you engage with advisors early to make sure you're on the right track and are recording things correctly, but also to fully understand the more detailed aspects if there's particular leases where it's not very straightforward to identify either the discount rate or the particulars of the contract. If it's, you know, there's no written agreement, but you know you're going to be in that building for another 10 years, these sorts of things. I think engaging early just means that everyone is on the same page. Oh, now it comes up. So I think I've just about done that in the time allocated. More than happy to take any questions. I have got 2 here, so I'll just have a quick read of those. So one of the questions was, for short-term leases which are likely to be renewed in following years, can we still apply for exemption? I think in this case, you would need to look at the contract. You would need to understand what is implied. Is it that, okay, the contract ends there, but there's a break clause, or is a contract extension? I think you really do need to look at substance over form with some of these, and it's not as clear cut as the contract's going to end next month, therefore it's short term. If you know that implicitly you probably are going to be there, so I'd probably say take some advice on those more quirky elements to the leases. Okay. So next one is quite a long one, so I'm just going to have a quick read through it. So it says, in terms of variable payments for lessees, would this be referenced to rent-free periods and half-rent periods under the current FRS 102? The total payable over the lease period is recognised equally across each period. So yeah, so at the moment you would recognise it equally over the period. What you would do if you were looking at the new rules is you would bring in those variable payments at a best estimate at the point of identifying that right of use asset value. You'd then obviously discount that to present value and then depreciate it straight line over that period. So hopefully that answers that one. Are there any other questions? If you have a question, you want to pop it in the chat box. If not, please feel free to drop me an email. Be more than happy. Or of course, if you want to contact your MC partner. Okay, I think I've got one more coming in. Just wait a moment because I can see someone is busy typing. Will apologise as well. This room is so bright, so my eyes have gone a little bit jaded in the sun. Not that I'm complaining. The sun is good. Okay, so the question is, if a liability for the lease has to go on the balance sheet, including an assessment of the dilapidation cost, will this go to the P&L in 1 year rather than in year one, rather than having a prior year adjustment? So I think in this case, you would need to look at the two aspects. Obviously, the dilapidation provision would need to meet the requirements of the provision element of FRS 102. And if it did, then yeah, you would bring it into the value of that right of use asset, and then it would be depreciated straight line. So it would have hit the profit and loss, but you wouldn't need to do a prior year adjustment in that case. Hopefully that answers it, but obviously with anything, if there are specific technical areas, if there's particular nuances to any aspect of a contract as you're looking through it, you know, please feel free to get in touch. And that concludes today's session. I hope you found it useful. Recording and slides will be emailed, and I look forward to catching up with you soon. Thank you.